So you get to see the best smile in insurance there with Vince. Just a sincere smile, who's so happy to be here and to sell insurance and to take care of his clients in a way that most don't. Because you don't see smiles like that very often, but it's a great smile. So
it's really easy to do when you're genuine, right, Randy?
Absolutely. When you're 100% authentic, there's absolutely no problem around that. I'm gonna turn that light off. It's not gonna.
Even in 2020.
Even in 2020, baby. So, first of all, thank you everybody for joining us today. The discussion is predicting financial success, and and this is primarily for first generation entrepreneurs. We ourselves work exclusively with first generation entrepreneurs, and one of the things that we've seen over and over and over again is the difficulty that businesses have with predicting financial success via cash flow. and so Vince, we'll introduce him in a second here, has a unique expertise and background around this, and we just think it's a good time to talk to people, particularly here at the end of November with all the budgeting and planning for next year, which it's a tough year to budget for next year and plan for next year, because so many people are accustomed to regularly using what happened the year before for the next year. And obviously this year is a totally goofy and kooky year. And so it's really hard to do that. And so, we think it's a good time to have that conversation and really do it organically. So, Gerber, as I said earlier, works exclusively with first generation entrepreneurs, and our average size company is about $45 million of sales. So we've had a lot of experience with companies that have grown over time. And one of the things that we've seen is they've been able to grow and spin off good cash flow as they go. And eventually, the better the cash flow you have over time, the better exit you likely have. That's part of what your goal is at that point. So we've seen what our clients have done, and we've developed some thought leadership around this over time as well too. And Vince, I'm going to let you, aside from having the best smile in insurance and most authentic, I'd like you to introduce yourself and give us some background information on what you've been doing and why you're here.
Sure. So thank you, Randy. Pleasure to be doing this with you. Vince Stasiulewicz. I've been monitoring everyone as they've joined. Great to see some friendly names joining. Hopefully next time we do something like this, we'll all be able to do it in person. Obviously, right now I work for Hylant, sixth largest independently held commercial insurance and risk management agency, but even more prevalent to this phone call. For 13 years, I was a partner at BDO. On the audit and consulting side. Obviously, a lot of people will probably be, why is my insurance agent talking to me about cash flow forecasting? Well, the predominant portion of my background was working with companies, small, medium, large, public, private, family office, private equity owned, helping them figure out the ramifications of their decisions, helping make sure that they're using the right accounting and timely accounting data to help lay a foundation that's able to breed success into the future and help them understand the ramifications of their operating decisions. Obviously, when things are going well, the mantra tends to be grow, baby, grow. And, for a lot of my clients, cash has always been historically light on the balance sheet, because oftentimes operators are using that money to reinvest into the business and grow for the future. Unfortunately, many of us, all of us, were dealt an unforeseen deck. Not that there haven't been pandemics before, but I don't think there's very many people, except for maybe Bill Gates, that thought that there would be a pandemic this year. So, I've had a lot of conversations with clients, prospects, people in my network over the last 8 months. I've had an extensive background in helping clients create cash flow forecasts, as well as understand the data that they're putting into those cash flow forecasts to make sure that they're using data that's not only timely and accurate, but able to be acted upon to achieve the intended goals. And obviously, for those of you that are on US GAAP accounting, there's a lot of other reasons why cash flow forecasts are important. Items such as valuations of your business, for purchase accounting, for exits, for going concern assumptions, analysis that maybe your auditors had to engage you with this year, as well as supporting the net asset value of your fixed assets, property, plant, and equipment that you have on your balance sheet to make sure that impairment doesn't need to be taken. So hopefully we can share with you a couple of things today that our clients have been saying, as well as some of the things that are relevant to creating an accurate and timely cash flow forecast, as well as what exactly should you be using that cash flow forecast for, not only for yourself and your own decision making, but also in conversations with your partners, such as your banks, lenders, other people that are obviously going to be wondering how you're looking from a financial perspective in light of everything that's went on over the last 8 months. So sorry for rambling there, but thank you all for joining. And I hope there's at least a few things that you can take out of today to help all of you in some form or fashion. So back to you, Randy.
Yeah, Vince, we're going to try to limit your answers to 2 minutes or less going forward. So, so just as a matter of function, let's keep everybody's phones on mute. And Annie's here helping moderate the speaker. So at some point, the video will focus on me, but until then, just going to look at her too. So if you guys have questions, put them in the chat box or comments, and that's what Andy's going to be checking as we talk. And we'll try to answer the questions at the end. So Vince, one of the things that I've seen, and we have over 200 clients, that so many entrepreneurs confuse profit versus cash flow, and so many people they use their profit and loss statement. And let me ask this question: how many in your experience how many people do you see really understand a statement of cash flows?
As being someone that did that as an accounting service for my clients for 13 years in public accounting, I would say not very many people understand or even utilize the statement of cash flows the way that they should.
Yeah. So, the first observation that I have is, one of the first places we look is that so many people are using their profit and loss statement and their balance sheet to make decisions on a go-forward basis, when in fact those are historical documents, and so is a statement of cash flow for that matter. And almost always when I introduce the idea of a cash flow forecast, people kind of balk at it. Like, we can't predict what's going to happen. We can't predict revenue. We can't predict the expenses that are coming down the road. In your experience, Vince, both as a vendor to companies in insurance, and also when you were in public accounting, those companies that were able to master a cash flow forecast, did they perform better than others?
Absolutely. And on top of it, based on the conversations and the transparency and having that information timely, it allowed them to better control variable costs, which obviously I would say one thing that people are really focusing on because of a reduction in sales for various reasons are trying to figure out how do we control our variable costs to make sure that, our revenue is going down, but how do we make sure that we're not bleeding cash so we remain viable into the future? So,
and in my experience, the cash flow forecast is a pretty simple exercise, and it should be done weekly, because it's, in my opinion and experience, and I'm going to ask you yours, Vince, too, that it should be a 13-week forecast, in part because, on a calendar quarter that week and the next quarter, there could be things in there that are quarterly, that are in, in that tempo. But basically it's a, starting cash position, expected revenue coming in, expected fixed expenses, expected variable expenses, and then, some financing activity, right? And then an ending cash position. Is that something that makes sense, or should it include more things, or what's your take on that, Vince?
So essentially the biggest way that we had to focus on it when I was in public accounting was we've referenced the statement of cash flows, we referenced the income statement, we've referenced the balance sheet. Balance sheet for many tends to be an afterthought because for a lot of businesses, cash is king. But obviously, one of the things that we probably will talk about later is where do you even start? And to your point earlier, it seems like everything is changing every day. Obviously, I think there's a lot of people on this call that tuned into the press conference yesterday. Now we have a curfew. We've done several of these in the past on various topics. And I think one of the things that I've said every time is I'll tell you what I think, but don't take that as the gospel because we don't know what's going to change tomorrow. So one of the things that I think that you touched on there is that the cash flow forecast needs to be a fluid process and something that you're always revisiting and sharing with your constituents. Cash flow forecasts are ultimately the confluence of operations and finance. It's one thing for someone to sit in the back office and put together a statement, but if that's not shared and the directives that you're trying to accomplish are not shared with your operational teams, then the likelihood of that cash flow forecast being successful is highly remote.
So Vince, let me interrupt you for a second here. So you said something that I was going to touch on, but since you're bringing it up right now, I think it's really good timing. So what I've seen with most entrepreneurs who don't have a cash flow forecast, that they don't understand the difference between operationally driven cash flow and financially driven financial maneuvers driven cash flow. And the reality of the situation is that you really should be building your business to spin off operational cash flow, and you use the financing activity for growth purposes and for other maybe CapEx related expenses. And so, in your experience, how many folks don't, make that mistake, certainly without having the proper projections, the cash flow projections?
Initially, before they get really any sophistication based on growth, pretty much everyone. A lot of people look at it from the perspective that as long as we know that we can make payroll, then we're doing okay. But obviously, sitting by in that mode and waiting for things to happen, not communicating as a group, not aligning the operations and the finance together doesn't get you anywhere in terms of optimizing performance or producing incremental cash flow based on sound business decisions to help you run more operationally efficient. So pretty much everyone initially runs into that problem.
And then, who do you think on your team should be responsible for the preparation it's not preparation, it's the management of the cash flow forecast, and kind of answer the question from the standpoint talking about a business that maybe is $3 million of sales and under, and then maybe a business that's $10 million of sales, and then a business that's at, well, obviously the bigger you get, you have a dedicated person, but in your opinion, who should be doing this for these different size companies?
So to your point, obviously you can finance function can come in various models. You can outsource the entire function. You can have a staff accountant that's really your primary financial responsibility person. You might be big enough to where you have a controller, and then large enough organizations have a genuine CFO. But ultimately, because the data in terms of the accounting system is always going to be the start of a sound cash flow forecast, and using that cash flow forecast to share with the operations teams. The individual that should really take ownership of the creation and dissemination of the cash flow forecast is the head finance individual within the organization or in your outsourced function. Ultimately, from the point that it's created and shared, I would think that that individual would also lead up getting together a meeting once a week, maybe once every couple of weeks, depending on the size of the organization or the frequency of change, to make sure that the operations teams and the finance teams are communicating timely and effectively as it relates to the forecast that has been created and any changes that need to be made.
You know, and one of the things that you referenced there is insourcing it or outsourcing it. And, you know, I don't know there's a one great answer to that. I think a lot of it comes down to the quality of the person. We've definitely had, you know, one of the problems that I've seen in the past is that entrepreneurs themselves don't fully understand that they need a partner internally financially that helps them make strategic decisions around cash flow. And they don't understand the difference between a bookkeeper and an accountant and somebody, somebody who really is helping you strategically generate cash flow. At the same time, on outsourcing, we've seen it both ways, where you get the right person or the right organization that can be really powerful and effective. And one of the reasons why on the outsourcing basis is because they have experience across a variety of sectors, a variety of businesses, you know. But oftentimes we see, or sometimes too, some of the folks providing this system on an outsourced basis are outsourced for a reason, and it's usually not a good one. So any insight there, Vince, in terms of your experience with insourcing and outsourcing?
No, I mean, honestly, everyone, I think from the beginning, most people start maybe with QuickBooks, maybe with an outsourced provider that handles the QuickBooks, does everything. And then obviously for a lot of companies, as you grow, it ends up leading to the development of an internal accounting and finance function. However, I was having a conversation with a good friend who has an outsourced accounting firm that has clients nationwide out of DC. I asked him the question yesterday, out of your hundreds of clients, you know, what is your smallest and what is your largest? And they predominantly do restaurants, and they have operators that have one location, and they have operators that have 200 plus international through franchising. So ultimately, you know, not everyone is created equal. People have different models. People have different, you know, views in terms of, do we really want to pay to house an internal accounting department, or do we feel that the data and the communication that we're getting out of the outsourced provider is viable enough for us to continue to grow with them? And ultimately, at the end of the day, that's a business decision, but there's no one size fits all, and there is no limit in terms of how large you can actually be, where outsource may make sense based on the decisions that you make internally as business owners and executives. So,
Got it. You know, one of the things that we try to encourage people to do is have, from a cash flow future perspective, is look at the worst case scenario, realistic scenario, and best case scenario, because it is a projection and prediction, and it's hard oftentimes to get that right. Talk to me. I know. So I guess the other thing too, one of the trickiest things that I see for businesses is getting the benchmarking accurate or key performance indicators. And one of the very common things that I see with not with our clients necessarily, but with people, is that they're using lagging indicators, using lagging data, and they're not using data that's predictive in nature, because it's one of the things that, as I remind myself all the time personally, that that if I want to lose weight, I weighing myself every day doesn't help me with decision making. It's a lagging indicator. Whereas if I measure the calories that I'm eating, that's a leading indicator. And for businesses that are in high growth mode, I often see that they don't do a very good job spending time figuring out what are those leading indicators that help us make better decisions? So a good analogy, one of our clients who's a traffic lawyer down in Florida, and it's a very, very large law firm. They pretty much just track the price per gallon of gasoline and the weather. And they can see what's happening, and they can tie their advertising to that because of it. And it's really allowed them to dial in a very, very efficient practice because everything they're doing is a leading indicator. So, and Vince, in your experience, the company, how many companies do you see historically, or I guess maybe the question isn't how many, but what size a business, and talk in terms of gross profit, because obviously, depending upon what kind of revenue what the construction of the revenue is different than gross profit. What do you see from a sophistication perspective? People start, at gross profit level, they're able to start developing leading indicators.
So if I can answer your question appropriately, initially when people start to develop a financial function, unless you're a not-for-profit where you have a requirement to put together a budget for the authorities, for the lenders, for the government, for your board, a budget isn't ultimately always part of what the initial financial package is. But my view would be is you're never too small to start putting together a budget, and then once you get to the point of creating the budget, one of the things that you mentioned was benchmarking against the industry. One of the things that we did when I was at BDO was we put together a quarterly report, thought leadership product called The Counter. Give my friends a shout out over there. Essentially what we did was we used 10Q, 10K information that's publicly available, broke down the restaurant industry in that particular sense by segment. We went into things like gross profit, which for restaurants was the combination of labor and benefits and food and beverage costs. We broke it down into commodities. We broke it down into what was happening in terms of same-store sales. What was labor and benefits running as a percentage of sales. For most businesses, if you have a financial statement that is laid out in the right way, every industry pretty much has a standard template. Those that are used to doing business in the industry, in any industry, often expect to see certain line items on an income statement. And from the point that you set up that financial statement structure to be laid out that way, the best way that people often analyze each line item in terms of how are we running in relation to the industry versus our budget is oftentimes done as a percentage of sales. Ultimately, one of the things that I know that I wanted to talk about today is your decision making is only as good as the data is. A lot of people, when they set up chart of accounts, don't really think about, okay, when I have these groupings for the financial statements, how do I put these individual accounts into the right groupings? So when I'm looking at my line items as a percentage of sales to compare to industry or compare to budget, how do I know that those percentages are accurate in the sense that I have the right expense accounts in the right line item? So the very first thing that everyone should do is form a financial statement that is grouped the right way. So then in that turn, you could use that to use the industry data that's available through sources such as the SEC with 10Ks and 10Qs, other industry providers that are out there that produce timely information without disclosing company names, and then ultimately creating a budget, a cash flow forecast, and a financial statement that uses the data that's available to help you mirror and benchmark yourself against other viable operators to make sure that you remain viable into the future and are producing a cash flow that's either equivalent with people that are doing things the right way or even better than that, even better than your industry's average.
It's interesting. So we use two different benchmarking tools that one of which looks at privately held companies' performance, and we can actually look at it from a geographical and industry perspective, where how does this painting company compare to this painting company in Central Ohio, and the data is comes off of tax returns that are submitted anonymously. And there's also other tools out there like Capital IQ, which deals with publicly traded companies and private equity finance companies. And the point is, I've always found it helpful on the do those comparisons, because if you have an anomaly in your business for some reason, you have to get your arms around what's happening, and particularly if you do this analysis year over year, because when you're thinking about deployment of capital in your business, and this is one of the things that we've seen so many, I think when you go back and look the last 10 years, one of the exposures that we had this great macroeconomic environment, and revenues and businesses grow. But what COVID exposed was a lot of these small businesses didn't have much cash or any cash at all. And you ask yourself, how do we get there? How does this happen? And the answer is, I think businesses got sloppy. They were chasing revenue. They weren't chasing quality revenue. And they weren't measuring their deployment of capital internally to get that return on investment. And one of the reasons they weren't doing it, they didn't have good key performance indicators. They didn't have good benchmarking compared to other peers, which is why I think it's so important, to look and evaluate how are you performing financially to your other privately held peers, in this session. And if there's anomalies, dig into what's happening. And in my experience, so many entrepreneurs develop a narrative in their head. They tell themselves to make themselves feel better, or they heard it from somebody else once and it becomes law, versus, hey, how do we actually do when it's all said and done? It's just, but it goes back to the more and more you practice your cash flow forecast, practice your benchmarking, practice developing key performance indicators, the better off your business is going to grow and the more valuable it is. And I'm kind of curious, Vince, and I'm not trying to be cute in saying this now, but when people do this, how does it help with the insurance component of it and the risk, not just the insurance, overall risk management in the business? Did we lose Vince?
I think we might have lost Vince.
Huh? All right. You know what? So here's the problem with Vince, is that he does not have an accurate cash flow forecast. He's not paying his internet bill, apparently. And so we just lost him. So, there he is, smiling.
Randy, I'm back. Sorry, my video went completely down. Can you repeat your question, please?
Well, I just said that you must had a poor cash flow forecast and didn't pay your internet connection.
Right, exactly. No, I think you said from an insurance and risk management perspective, in relation to
those companies that have good, cash flow forecasts, those companies have good key performance indicators, yep, and good benchmarking. Yep. Are they better risk managers?
Yes, ultimately, because to create a cash flow forecast that's viable, that uses accurate assumptions that you use for decision making, you have to really, really understand the variables, the dynamics, the macro factors that are affecting your industry to be able to manage your cash flow appropriately, right? In order to get to the point where you feel like you have a sound foundation of what your decisions are and how they're affecting the numbers, that obviously means that you have to understand your business inside and out from a controls perspective, which correlates to a risk management perspective. Ultimately, the way that we try to treat it at Highland, which I believe in a lot of ways is different than our competitors, is we think about how could the decisions that we're making as a business, if something went catastrophically wrong, what would be the material impact of what that event would create in a dollars and a cents perspective, and is my balance sheet strong enough to be able to support that worst case scenario? The better that you understand your business, the better that you'll get controls in place to help you manage your risk, which then can do lots of things in turn for you in terms of, say you have a $5,000 deductible on your property and casualty insurance right now. Understanding your business, relating that back to your cash flow forecast, improving that balance sheet allows you to do things like explore self-insure, explore captive, explore taking a higher self-insured retention, higher deductible. The two really go hand in hand. In general, the better that you can manage your financials, the better you're going to manage your business and the better you're going to manage your risk. Hopefully that answers your question.
Yeah, no, it does. And actually, it leads me to another thought that is probably touchy for a lot of folks. And that is, in my, regular experience, that those folks that do a good job with their cash flow forecasts and KPIs and benchmarking, and they do a nice job of modeling out a best case, worst case, and most realistic case scenario, share that with your bank. And I know people are oftentimes scared to talk to their bank, and I understand why. And, one of the challenges with banks is that, you have to deal not only with your own agenda, but their agenda too. I mean, we've had it happen. We had a situation a few years ago where we got a verbal commitment from a bank in town for a client, and all of a sudden they reversed their position because a competitor in their same industry had just had a blow up, and they didn't want to have any more exposure in that industry, and it's, I understand it, don't like it, but that's where, when you're dealing with the bank, you're dealing with multiple agendas often there. But my point is that when you do a good job proving over time that you're a good manager of cash, you're a good manager of and understanding the risks in your business, usually banks will err on the side of working with you, because they do, they want you to grow your business, because they want to have you have bigger loans and more cash management tools and everything that goes with it. So it's not just a risk management issue. And obviously, if you have investors in your business or you're thinking about having investors, it's very important to do this. Yeah. It's important for the bank. And I also, I touched on this earlier, but it really does that, your best investment should be your business. And when you're managing your cash, you should be getting a great return on that. And, one of the things that we see all the time, and many of you probably heard me say this a million times before, is that as a business is doing well and is spinning off free cash flow, get it off that business balance sheet and put it on your personal balance sheet to diversify your infrastructure risk. Because as the business gets bigger, as you have more, bigger leases, you have more employees, you have more customers, and you have more headaches, make sure that, and we hear this all the time, that all our money is wrapped up in the business. Well, when something goes wrong, and it's not if, it's when, having money, having liquidity on your personal balance sheet makes a huge difference. And that's where I do think, I hope that COVID-19 has taught entrepreneurs that you can generate cash and spin it out of the business, because you could. It's a discipline issue over time. So, yep. Vince,
I would say out of all the conversations that I've had with my clients over these last 8 months, I think the general perception is, it's very important to have accurate data. It's very important to have timely data, and running and hiding because you're worried about what your covenants are going to look like, or whether or not you're blowing a covenant with the bank, is going to do nothing to further that partnership with your bank, or let them know that you're going to remain a viable going concern into the future. I would say the individuals, the clients that were most on top of their financial data during this and were the most transparent are the ones that have been able to work with their landlords to get, either rent abatements or rent deferrals or rent reductions. I would say those are also the companies that were able to work with their public accounting firms, those companies that needed audits. If you had negative adverse financial performance during this, it's highly likely that you had to go through a going concern analysis. Having that data available, being able to explain to your auditors what assumptions you're using for that year from reporting date to show that you're able to continue as a viable concern, made those conversations go better, got you the audit report that you needed to be able to give to the bank to satisfy your financial reporting covenant requirement. And if you were having issues with things like debt service coverage ratios, fixed charge coverage ratios, working capital requirements, et cetera, issues with your financial covenants, I think banks in general were a lot more receptive to those that were out front with that, with their lenders, and probably a lot more successful in terms of getting waivers for the violations of those covenants and having that bank to work with as you move forward. It's just always a best practice to not run and hide, but really be current and share that information and be transparent and honest, because, you know, those individuals that you'll be having those conversations with, they've seen, they know enough, they've been doing it long enough to know who is really trying to provide all the data to the bank to be transparent and who isn't. And whoever is trying to be transparent is always going to be the individuals that the banks would rather work with into the future. So.
Yeah, and it's not just being transparent, it's also being consistent as well. I think that it's, you know, and that's really just, you know, you have to be consistent with the information shared with your bank. And I think it's really important. You know, the other touchy topic on this is, and I don't know there's a necessarily a right or wrong answer here, but sharing all this information with your employees. I mean, certainly you need to share it with your leadership team, right? And some companies have adopted the philosophy of sharing it with the whole organization for supreme transparency, and some people aren't comfortable with that. And you know, I frankly haven't seen enough consistent proof one way or the other what's better. I know some people have very strong opinions about that, but I think it is important when as you develop these KPIs and benchmarking and cash flow to really sit down and be thoughtful. Who are you going to share this with, and what's the consistency of sharing it? And the other thing too, by the way, kind of a curveball topic, but not unrelated, is, you know, you got to think about cash flow as it relates to your personal life as well too. I mean, I think virtually everybody on here is a privately held company, and so I always say there's competition for cash with your household and your spouse. That, you know, from the standpoint, are we going to buy a new big home somewhere else, or buy a new piece of equipment, or you know, hire a bunch of people, or send our kids to an expensive school? And oftentimes, you know, the spouse is not aware of what's happening cash flow wise in the business, and, you know, they are making commitments. And so I think, you know, that's one of the risks we see all the time with first generation entrepreneurs, is they're just not transparent across the board with all the stakeholders, of which oftentimes their spouse, with cash flow, and it cuts both ways. Now, you know, I don't, we have a few clients who do a cash flow forecast for their business, and underneath it, they have their household cash flow. You know, they're predicting the next 13 weeks. You know, that's taking it to another level. But, you know, certainly in the early stages of growing the business, or if you're in a high growth where there's a lot of, you know, because as we all know, high growth sucks cash out of a business. You know, it just does. And even if you have a great relationship with your bank, it's so hard to keep up with that, right? And if you're in that family situation too, where your family's going through a growth situation, whether it be your kids are going into college years and you haven't saved, or there's private high schools, or God forbid, a health issue, you know, where there's cash competition. So it's one of the unique problems of owning a business and being an entrepreneur, is really, you know, understanding that cash. Vince, were you going to say something to that?
No, another thing that I've heard a lot of recently is, you know, I have clients that unfortunately, through none of their own wrongdoing, same store sales are down 60-70%. And, you know, how do you deal with such a large blow and literally remain viable as a going concern and not declare bankruptcy, right? Like, the biggest thing that I've heard that people have done during this that I believe has been most effective is those companies that had accurate data, timely data, appropriately grouped and organized data, are the ones that were really, really able to dig into their variable costs. I think I mentioned it earlier, but when things are going well, if you build it, they will come. Well, 2020 taught us all that even as good as we think, stock market's at all-time highs, unemployment at all-time lows, and then boom, right? So many businesses were impacted that were maybe reporting all-time record numbers, and now are reporting the lowest numbers that they've ever reported in the existence of their businesses. But what I have heard is those that didn't become paralyzed, remain change agile, work with our operations teams, and really looked at their variable costs. Those that were down even maybe 60-70%, I've talked to several of them recently, they are actually producing positive cash flow. And part of that was that, in situations where maybe they were running a little bit fat, maybe they were running high on G&A, especially for a mature business that should have pretty controllable, comparable, predictable G&A. They were able to dig in, have conversations, again, being transparent with landlords and banks and vendors and everyone else, and really figure out, what am I spending money on that maybe isn't essential? Maybe it's something that we spend money on at some point that was viable and our business has changed, and then you uncover, why are we still spending money on that? And it's been remarkable, based on these conversations, based on the financials that I have seen in consulting with my businesses, how even in the face of significant revenue declines, people are still able to produce positive EBITDA and positive cash flow. Again, it's just all making sure that the data is there and current, and you're digging in and you're having conversations with your partners to provide viable suggestions, looking at that benchmarking data, using what's available, publicly available, for oftentimes for free, to help you figure out where's the fat and how can we cut it and how can we move and be change agile into the future to remain a viable going concern.
It's interesting you say that, because I was told a statistic and I didn't validate it, but I believe it to be true, that 18% of the companies in the Russell 3000 don't have enough cash flow to make principal and interest payments. And, you kind of, as a small business, and, everybody on here is a small business, you kind of marvel and say, how is it possible that these companies, and this is, by the way, pre-COVID. This is pre-COVID. This is not, I don't know what the numbers are post-COVID. But going into
I don't even want to know.
Going into this, with unemployment at 4% and one of the best economic expansions and revenue expansions we've had in a long time, and with all the tools we have available to us today, how is it that 18% of the companies in the Russell 3000 cannot make principal and interest payments? And so my point is, the problem around cash flow management is not unique to small businesses. It's a cultural thing, and that's, in my opinion, one of your responsibilities as the shareholder of your company is to create a culture around return on investment, create a culture around consistency, create a culture around generating operating cash flow. And it's interesting how many employees think that financing cash flow is an okay thing. And it's okay if you're in a hyper growth mode, but, from an organizational perspective, you want to be very focused on operational cash flow, which is, and Vince just alluded to this a second ago, which very well may be different than operational profit, right? and you need to spin off that operational cash flow. And so there's no shortage of tools and opportunities, and for that matter, people, but it really is your responsibility as a shareholder of the company to create that culture and create that expectation and create that discipline around creating operational cash flow. So two quick things here. One, I think we marketed this as a fireside chat, and I had delegated that to Vince, and obviously he's not behind the fire.
I dropped the ball again. My planning skills are nearly as bad as my internet connection.
So I think we have two questions, or maybe one question. I saw one for a second. What's the question, Annie?
From Steve, he's asking, for companies running EOS, would you think the cash flow projection would be part of the scorecard and reviewed every week, or would this be a separate?
Yeah. So my friend Steve Harmon, shout out. He's a great businessman and great Buckeye, and overall great guy, and a super exciting golfer, is asking the question that should your cash flow forecast be part of your scorecard on EOS. And I understand why you're asking the question. In my opinion, the scorecard and EOS and traction, if you can figure out how to make that whole thing predictive and boil it down to a number, that's better than having the cash flow forecast. Now, if there's something on there you can do on the scorecard that is a number that people can understand that's predictive of where you're going, I think that's good. But for me, it's really the scorecard's about marrying financial data with non-financial data. And that's not what a cash flow forecast is. In my mind, I do think in your L10 meetings, it's totally appropriate to carve out, because you can customize that. I think you know that. Carve out a minute or 5 minutes to review the cash flow forecast. But I don't, the scorecard, and I've been asked this question before, I think it's tough to put on the scorecard. And the other piece of it too, the reason why it's also hard is sometimes, some folks just have it's such a specialty, have no control over that. So that's a great question, Steve, and I appreciate it. And I know you run a great business, and I'm sure your scorecard is just top notch. Well, so Steve's the only one that had the courage to ask a question so far. Oh, John Cadlick.
Can you talk more about some of the key operational areas you would look at as part of the cash flow analysis process?
Yeah, so think about the business. Man, let me read the question so I can repeat it loudly. Yep. The actual question is, talk more about some of the key operational areas you would look at as part of the cash flow analysis forecast. Vince, I'm going to, before I monopolize this, I'll let you answer that first and I'll chime in. Do you get the question?
No, Randy, what I would say is, at least for me, the foundation of the cash flow forecast is going to be your income statement. So if you look at the financial statement in the form of an income statement, and then you add reasonable inputs to it to build projections for whatever time period you're looking at, ultimately you need to look at you're focusing on the expenses within that income statement to build the foundation, to get to EBITDA, to build the projections of cash flow. And every single expense that runs through your P&L relates to every facet of the business, whether that be purchasing, procurement, accounts payable, supply chain, whatever it may be. Every single thing that you do for anything that generates revenue, or even sometimes non-revenue generating, results in a reciprocal expense. So ultimately, you need to break down your business into quadrants, which varies by industry, and then focus in on those and relate that back to the costs. Ultimately, figure out where you're at as a percentage of sales by each of those expense line items, and figure out what can be done if you're running high or too low to get back in line with the industry and your forecast and your budget. But it's really every operational aspect of the business, because you're analyzing all expenses that run through the company, which ultimately affects every part of the business.
And so you just heard a great answer from a classically trained CPA, and I'm going to give you a slightly different answer. I agree with what Vince said. And John, who I think I understand the root question you're trying to get to. In my experience with this, think about your business, the core, the real core of what you do, and the core of what you do that spins off the cash on a day-to-day basis, because so many folks have other activities, other operating activities that are experimental, or they're there for some legacy reason. I mean, the best analogy I can give is, and COVID proved it, right? That these restaurants that shut down, the restaurants that didn't shut down, that did carry out, they didn't offer the full menu for carry out. They offered their items that had the most profitable and best selling. And so for a lot of our clients, I'm like, well, hold on a second. Why do you carry the Polish sausage on the menu if you lose money every time you sell it? And the answer is, well, Mr. Cadlick comes in every weekend, and he and his wife love the Polish sausage, and they order it, and we lose money every time they buy it. And so that's a good example of something that is not high quality revenue. Like I said earlier, that you think about your business, that core activity that spins off cash. And to me, that's where you really want to identify those expenses and revenue levers, inputs and outputs, and try to get some KPIs around that. And by the way, for those who are unsure, that was John Cadlick, who is the most handsome man. He splits his time between Boulder and Columbus. I mean, it's unbelievable how handsome he is. But thank you for the question, John.
I don't have any more on my end.
I'm going to check my chat.
We have another one from John.
Okay.
In this time of COVID, how many months of cash do you recommend keeping in the business at this time versus more normal?
That's a really good question, and I'm going to answer it that I don't think it makes a difference.
It changes every day, right? Because there's so many variables, so many government officials that are creating orders, making changes. It's the answer, honestly, in a broad sense, right, Randy, would be more than you had in March, right?
Yeah, I mean, I agree with that. My pushback is this: that you got to think about. We try to get our clients. So it depends on the nature of your business, right? So if your business is totally transactional and it's always transactional, then you need to be a little more thoughtful about having more cash. And I'll give you a hard answer in a second. And again, if you have a recurring revenue component to your business, a contractual piece, there's a little less, assuming that you kept those. But in my mind, for most businesses, you're talking in shortest period of time, 3 months, usually 6 months of fixed expense cash, right? Fixed expense cash. And then you want to have financing ability on top of that. So the thing of it is that if you think about what happened with COVID, for most, not a high percentage of businesses, their revenue is dropping. And so if you have that 13-week cash flow forecast and your revenue is dropping, you got to marry your expenses with that, right? And that's one of the biggest mistakes I see people make all the time. They don't adjust their expenses quick enough, fast enough. They don't go deep enough. They don't go quick enough to cut their expenses. So if you think about that, if you have a model what really truly is real time, and as your revenue's dropping and you're able to drop your expenses, then having 6 months of fixed expenses going forward should be sufficient. Now, to Vince's point, we live in unprecedented times, the combination of a pandemic and also the unusual presidential election. Of course, it was safer to have more cash. The one thing I'd caution about that, though, particularly for small businesses, that these are also the times to be opportunistic. And so, it's a combination of, have cash, but boy, if you could pick up an asset or pick up a business, or probably more importantly, pick up, great people for your team, you might need to spend some money for that. Because one thing we are seeing, and we're seeing it firsthand ourselves, we're seeing it with our clients, that the talent pool out there is disrupted and really good. And you can pick up some really great people who either, for whatever reason are out of a job, or better, they just want to change the scenery. They want to go from a big company to a small company, or they want to change, where they're living. But, I think you shouldn't be afraid to deploy capital now to improve your business. I see Vince, you want to say something, I think.
No, to piggyback off of you, and I'll keep this brief. I know that's not my best strong suit, but I think with every catalyst event, in this case, it was a global pandemic, there's going to be winners and losers, right? And, even within the same industry, I've had clients that are up 30% same-store sales. I have clients that are down 70%. So even within the same industry, it's been all over the board. But one thing that I think is more prevalent now, especially for those that, were winners as a result of this, to take advantage of, to your point, I believe good labor is more plentiful than it's ever been before right now, because of the businesses that have been negatively impacted that had to lay people off or do furloughs or reductions in force. And the other thing that I think is more prevalent and stronger now than it's been in a long time is real estate and site selection. I think that those that had a strong balance sheet going into this, Obviously, we got some good news from Pfizer and Moderna over the past week about readily available, highly successful vaccines. But I don't think we're done seeing the shakeout as a result of this through Chapter 11, Chapter 7 bankruptcies. But, to your point, spending ahead to procure things now, like good labor, good real estate, whatever that may be, as part of your overall business philosophy, I believe is going to really set people well for into the future, and be even more viable and successful than they were prior to the pandemic.
Yeah, and I think that's all true. We have another question here, and it is from Brad. And the question is, what recommendations do you have about forecasting collections? What would you base it on? Average days to collect, or would you try to get down to individual invoice timing? We're a professional service firm, averaging invoice around $8,000 a month, or $8,000. So the great question, Brad. This is where I come back down to a couple points we made earlier. Having a person on your team, insource or outsource, who's strategic and can help understand the cash flow tempo of the business is super critical here. Number two, I don't, in these times, like next year will be 30 years of business for me. And, so we've seen enough cycles of bad things happen. I in my mind, I don't think you should academically forecast this. I think this is, organizationally, you need to be on the phone and talk to people, and have them tell you. And if you have done a good job with your cash flow forecasting in the past, you can see how this changed. It'll start giving you a model as to, okay, you've gone from net 30 to net 45 or whatever the case may be. And I'm not even sure an average really matters equal, unless all your bills invoices are always around $8,000. That's usually not the case where there's a weighted, you might have a couple at 30 and 40 and 50 and a whole bunch at 8 and a few at 2. So, but to me, if you're looking for an average, I might say expect it to triple in time, because that's what we're seeing certainly on the rent side and the bank side for sure. But with these type, because with technology, we have seen that technology is viewed as much more it's a must-have, and so customers or clients or people are paying their technology bills because they have to have it. So, but I think the answer is really rooted in having your cash flow forecast and measuring, what's happening, and get on the phone and call people.
Yep, I concur.
Yep. So it is 1:57. I don't think we have any other questions. I do appreciate all the questions. Vince, do you have any closing statements or arguments besides your inability to provide a fire for us?
No, I wanted to bring it back to one of the things that we talked about on this call was benchmarking. It's one thing to have a budget, it's one thing to have a cash flow forecast. I think we beat home the fact that that's very important. But the other thing that you need to make sure you're incorporating is that benchmarking data. Randy, I think after this, I've got some really good links, some really good presentations that I've done in the past that I want to share with people that took the time and cared enough to be on this today, in terms of websites that you can go to. I'll make sure that we have a sampling of various industries in that listing that we disseminate to those that were on the call, where you can go and find some accurate data that stratifies the financial statements down into the areas that you should really be focusing on. So you can begin to, if you're not already, not only benchmarking yourself, budget the actual and projections, but also benchmarking yourself against your peers. Because obviously, if you're using the right companies to benchmark yourself to that are really best in class, that's going to do nothing but help you better manage your data and better manage your business and be even more profitable than hopefully you already are. So we'll make sure we get that out to everyone after this is over.
Yeah, thank you, Vince. Well, Annie, if you get to Annie, she'll get it out, and this has been recorded as well. So for those who missed it, we can get the recording of it. But I, for one, want to say thank you for spending the last hour with us. Hope everybody can figure out a way to have a fantastic COVID Thanksgiving. in this crazy world we live in, and get to spend some time with your loved ones one way or the other, and also get some time to relax and take some of the stress off. So thanks for coming, Vince. Thank you. I appreciate it. And everybody have a good day. Up. Okay. These are all thank yous. So have a good day.